The S&P 500 gained 0.35% this week. The VX dropped more than 6 points. By every headline metric, markets calmed down. And that calm is precisely the thing you should be suspicious of. Here is what was actually moving beneath the surface. A private credit fund, at one of the largest asset managers in the world, honored only 40 cents of every dollar investors tried to pull out. A default cycle in bonds was flagged. Not warned about, not cautioned. Flagged is already beginning. And a Fed chair situation just got significantly more complicated. The question is not whether this week was volatile. The question is whether you were watching the right instruments. Let's start with the number that should have been the headline. BlackRock's private credit vehicle honored redemptions at a 40% rate this week. That means if you submitted a redemption request, if you formally asked for your own capital back, there was a 60% probability you did not receive it. Not because of fraud, not because of insolvency, but because of how these structures are built. Private credit has been the darling asset class of institutional portfolios since 2022. The pitch is straightforward: higher yields than public bonds, lower volatility than equities, and access to a lending market that banks partially vacated after the regulatory tightening that followed the regional bank stress of 2023. As of early 2026, private credit assets under management globally are estimated above $4 trillion. That is not a niche. That is a systemic weight-bearing wall. The structural issue is a classic liquidity mismatch. These funds hold illiquid loans, often to middle-market companies, sometimes with 3 to 7 year maturities, while offering investors periodic redemption windows, typically quarterly. When redemption demand exceeds what the fund can liquidate without destroying NAV, the fund gates. It honors what it can, defers the rest. This is legal. It is disclosed in the fine print. And it is something most retail investors who access these products through wealth management platforms did not fully internalize. The actionable insight here is not to panic sell anything. It is to audit your own exposure. If you or your portfolio has capital in any interval fund, non-traded REIT, or private credit vehicle, check the redemption terms specifically. Know the gate threshold. Know the notice period. The 40% figure from BlackRock is not an outlier warning. It is a data point telling you the stress test has begun and the results are live. When Pimco uses the phrase beginning default cycle, that is not hedged language. That is a diagnosis. And this week, that language entered the conversation with enough specificity to warrant serious attention from anyone who holds fixed income or has exposure to leveraged companies. Here is the context. Corporate credit spreads. The premium investors' demand to hold corporate bonds over equivalent treasuries have been grinding wider through much of 2026. Investment grade has been relatively contained. High yield is where the signal is clearest. The cohort of companies that issued debt at near zero rates in 2020 and 2021, then refinanced during the brief window of rate optimism in late 2023 and early 2024, is now facing a harder wall. Rate levels have not returned to where those capital structures were modeled. Revenue growth for many mid-size companies has not kept pace with interest burden. Default cycles do not announce themselves with a single large event. They accumulate. The first phase is always idiosyncratic. This company had bad management. This sector had a specific headwind. The second phase is when the pattern becomes undeniable and repricing accelerates across the category. Pimco's language this week suggests their internal data places us at the early to midpoint of Phase 1. For equity investors, the relevance is not abstract. High yield stress historically leads equity stress by approximately 6 to 9 months. That is not a law of physics. It is a historically observed sequence. The mechanism is straightforward. When credit costs rise for leveraged companies, buybacks slow, CapEx gets cut, and earnings guidance gets revised. None of that is immediate. All of it is directional. The actionable takeaway: watch the ICE BofA High Yield Index spread as a weekly indicator. Not daily noise, weekly trend. A sustained move above 450 basis points would represent a meaningful escalation from current levels. That is the threshold worth tracking going into Q3. Two separate stories this week that appear unrelated but share a common mechanism. The market priced a narrative, the narrative partially broke, and the repricing was sharp. Start with SpaceX. Midweek, secondary market momentum around SpaceX's private valuation drove significant coverage and speculative positioning in adjacent public names. Launch infrastructure, satellite communication, and select defense contractors with space exposure. By Friday, that momentum had reversed. The reason is predictable if you understand how illiquid private valuations interact with public market sentiment. A secondary transaction or a reported valuation mark on a private company is not a public market price discovery event. It is a single data point from a motivated seller and a motivated buyer, often with strategic reasons beyond pure return optimization. When public markets trade on that signal as though it were equivalent to an earnings report, the correction is not a surprise. It is a reversion to what the underlying cash flows actually support. The lesson is not that SpaceX lacks value. The lesson is that momentum in private adjacent narratives has a very short half-life in 2026's liquidity environment. Now, Kevin Warsh. The speculation around his potential nomination as Fed chair introduces a policy uncertainty variable that equity markets have almost entirely ignored. Warsh is known as a more hawkish voice relative to the current Fed composition. If that speculation becomes a confirmed nomination process, the market will need to recalibrate its rate path assumptions. Not because Warsh's views are extreme, but because any transition in Fed leadership introduces forward guidance ambiguity. The Fed's credibility is, in part, a function of continuity. Disrupting that continuity mid-cycle, during a period of emerging credit stress, is a compounding variable. None of this is financial advice. It is a framework for understanding why the week that looked like a 0.35% gain was, in terms of structural signal, one of the more consequential weeks of the year. The surface was calm. The substrate was not. We opened by asking whether you were watching the right instruments. The answer this week was almost certainly no, because the instruments most people watch were telling a story of calm, while credit was telling a story of stress. That tension does not resolve quietly. Next week, we are going to look specifically at what a sustained high-yield spread widening actually does to equity multiples. The math is more direct than most people realize. Subscribe so you are there when that drops.